Hi, my name is Mike Tusaw. I'm a financial advisor from St. Charles Wealth Management. Today, we're going to talk about selling a straddle. Now, this is a trade that I have not done in over 10 years. It's something that I seldom, if ever, do, but I think it's important that you have an understanding as to how this trade works because it can relate to other areas. This trade involves selling naked options. That's something that I do not recommend. However, I think it's important that you understand the concept of how this trade works before you get into any other trades to where you're selling a call and a put along with doing hedge legs of trades as well. So what you're seeing on the screen is a risk reward graph, the exact opposite of what we posted last week when we posted our buying a straddle video. Now, full disclosure for the one from last week, I realized after production that the call price was off. So you'll see the one last week where the call price showed 220. It should have showed 230. That's why it didn't add up in case you were looking. So I apologize for that. Anyway, with this, what you're trying to do in this trade, the stock is trading at $45 per share, and you believe the stock's going to stay relatively still. You think it's not going to move. It's not going to go that much higher, not going to go that much lower. So when doing that, you sell a naked call at $2.30. Simultaneously, you sell a naked put at $2.15, both at the 45 strike price, right where the stock is at. That gives you a net credit of $4.45, or $445 per contract because we multiply these things by 100 in the option world. So on here, what you're hoping happens at expiration, and once again, this is an expiration day risk reward graph. A lot of times you'd be out of this trade long before expiration, but this is assuming you hold everything until expiration. What you hope happens is if the stock is at $45 on expiration Friday, the call expires worthless, the put expires worthless, and you made $445 on a stock that didn't move. Wow, that's easy, isn't it? Not so much. Now, let's take it out a little bit. Let's be a little bit more realistic on here. You can see the break-even point. The stock has to stay above those 2 points where it has to be to have it to where you're profitable. So if it is above $40.55 and below $49.45, then that means that you're going to make money. The break-even point would be those two extremes, $40.45 and $49.45. So at those two break-even points, the reason those are break-even is that you would have an obligation to, let's say it goes down to the $40.55, you have an obligation to buy the stock at 45 because that put would be in the money. The call would expire worthless. So you would get a $4.45 credit. $45 minus $4.45 is what $40.55. That's where that number comes from. Now, the opposite is true to the upside. If the stock were to go higher, you're obligated to sell the stock at 45. The put expires worthless, but the call would expire in the money, so you'll be obligated to sell it at 45, even though the stock is at $49.45. So by doing that, you can see that you have your peak, your best possible profit, if it's right at 45. If it goes beyond those two break-even points, that's where you start to lose money. And that's the scary part because you're actually naked on the trade. You have unlimited risk. One of the call or the put is going to expire worthless. Mathematically has to happen. But one of them is going to expire in the money, unless it's right at 45, which is extremely unlikely. So you're essentially selling a naked option, and you hope that you're correct on it. So if the stock stays between those two break-even points, you make money. If the stock goes below or above those two break-even points, you lose money. For every penny it goes above it, that's how much you would lose per share. If the stock were to go to $100 per share, you have a naked call taking you all the way to 100. You have no stock to support it. Stock goes to zero, you essentially bought that stock at $40.55. You would lose all your money with it. So have the understanding that if you get a lot of movement on this trade, it's not going to be very good. However, if the stock stays within the range, you will make money. So in looking at a straddle, It's something to where if you're exactly right, you can make a lot of money on it. It's very difficult to be exactly right. If you're kind of right, you can still make some money on it. So let's say it was $1 to the right or to the left of the 45 mark, you would make that whole credit minus the dollar. And of course, you have your break even points. So it's an interesting trade, but I want to caution you, I haven't done a naked option trade in many, 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 many years. Be very careful with this. If you enjoyed this video, please subscribe. That's how we get our content out to more people. If you're looking for a financial advisor who looks at straddles, although really doesn't trade them, feel free to reach out to me. You can check out my website, stcharleswealth.com, or you can follow me on Twitter at Mike Tusaw. When you go to my website, you can set up a phone call with me in one way, or send me an email in some way, shape, or form, whatever way you want to communicate with me. If you follow me on Twitter, I'd recommend you do so because I try to put out a lot of content. Thank you very much for watching and have a wonderful day.